The market is focused on today's jobs report out of the U.S., and the broad expectation heading in is that the labor market will continue to show improvement, albeit at a decelerated pace to what we've been seeing. NFPs are expected to come in around 1.4 million versus the 1.763 million in last month's report, and hourly earnings are also expected to come in below what we saw in the July report. As far as the unemployment rate is concerned, the expectation is that it will drop to 9.8%, its lowest level since the pandemic fallout peak, down from 10.2% previous. As far as takeaways go heading into the report, we think it will be worth keying in on the impact of the fallout on holiday hiring and educational hiring. Now that we're getting back into that part of the year, there could be some vulnerability that shows through in these critical sectors that may just point to the overall risk being tilted to the downside. We're not convinced that with the Fed already extending itself to the moon as far as accommodation gestures go, that bad news will necessarily translate into a positive reaction from investors leaning on the Fed to do more, as we have seen so many times over the past decade plus. On the currency front, it's also a tough call, as a softer report may put diverging flows at odds, with flight to safety demand for the buck putting up a good fight against any desire to see the dollar outflow from yield differential impact. What makes assessing fallout from today's report even more complex is the fact that U.S. desks will already be thinning out for the holiday weekend. And so, with all that said, we'll be curious to see where the chips fall, but also well aware that it may take some more time for the market to take it all in. That's all for now.